The Philippine infrastructure pipeline has reached its highest valuation in recent history. 252 active projects are currently in development, carrying a combined cost of 3.16 trillion pesos, roughly $112 billion. This capital is flowing into a severe transport crisis. On the ground, millions of commuters lose hours every day to metropolitan gridlock, creating a physical bottleneck that restricts the movement of both people and goods. In the air, the situation is similar. Passenger volumes have reached a level that legacy terminals were never designed to handle, resulting in chronic overcrowding and facility failure. With the state unable to fund the expansion needed to clear these blockages, we have to look at who is actually stepping in to provide the necessary 3.16 trillion pesos. This persistent infrastructure deficit has created a vacuum, a guaranteed market for any private entity capable of delivering a functional alternative to the current chaos. The legislative shift began in December of 2023 with the enactment of the Public-Private Partnership Code, or RA 11966. This law consolidated fragmented regulations into a single framework, standardizing how corporations bid on public works. This chart tracks the immediate response to that new legal clarity. Following the code's implementation, the pipeline grew to include 252 solicited and unsolicited projects, representing a surge in private sector interest. This transition is being supported by international institutions like the Asian Development Bank. Their involvement provides the institutional backing required to bring these massive deals to the global market. In late 2024, the ADB approved a $30 million loan to replenish the Project Development and Monitoring Facility. This revolving fund is used to finance the technical studies and project structuring needed to make these 252 projects bankable for private investors. The result is a pipeline that functions less like traditional government spending and more like a de-risked investment portfolio designed for large-scale conglomerates. No entity has been more aggressive in capturing this portfolio than San Miguel Corporation, specifically within the high-density Luzon corridor. Under Chairman and CEO Ramon Ang, SMC has successfully targeted the primary transit arteries that connect the capital to the rest of the country. Their most significant acquisition is the 170.6 billion peso takeover of the Ninoy Aquino International Airport. Through the NNIC consortium, SMC now controls the operations and rehabilitation of the nation's busiest gateway. This chart shows how SMC secured the deal. They offered the government an 82.16% share of airport revenues, a figure that effectively shut out competing bids from other international consortiums. To manage the technical requirements of this 15-year concession, SMC partnered with Incheon Airport Corporation, the operator of South Korea's main international hub. Beyond the airport, SMC is also constructing the MRT-7, a 23-kilometer elevated railway designed to link Quezon City to the northern suburbs. Valued at 62.6 billion pesos, the project is being developed alongside Korea Railroad Corporation, with a target to be fully operational by 2026. By securing both the primary aviation hub and a major rail artery, SMC is establishing a dominant position over the transit infrastructure of the capital. While SMC focuses on the capital, Aboitiz Infracapital has implemented a different strategy, capturing regional gateways across the Visayas and Mindanao. In Mindanao, Aboitiz secured a 30-year concession to operate and expand Laguindingan Airport, the region's primary travel hub. The deal requires a 12.75 billion peso investment to more than double the airport's capacity, scaling it to handle up to 3.9 million passengers. They further expanded this regional footprint with a 4.53 billion peso takeover of Bohol-Panglao International Airport, securing a key entry point for the Central Visayas tourism market. This methodical approach has allowed Aboitiz to corner the logistics and tourism growth of the southern regions, while the capital remains congested. For the individual investor, the scale of this 3.16 trillion peso portfolio raises a practical question. How do you trade a macro trend of this size? Market analysis suggests that the most consistent returns are found in spillover economics, the sectors that expand once the new infrastructure is actually in place. As this flowchart shows, a completed transit project creates immediate demand in three secondary areas: commercial logistics, regional tourism, and real estate investment trusts, or REITs. Look at the real estate node. REIT yields tend to rise when their properties are adjacent to new transit hubs. The increased accessibility drives up foot traffic and tenant demand, which in turn increases the underlying value of the land. To capitalize on this, investors have to map the geographic footprint of these conglomerates to see which commercial zones will be the first to absorb the new economic capacity. But executing a 3.16 trillion peso pipeline carries significant risks, particularly regarding consumer pushback and regulatory friction. Resistance is already mounting. A petition has been filed in the Supreme Court against the NAIA consortium, challenging the decision to allow a private operator to significantly increase terminal fees and charges. This highlights the core trade-off of the PPP model. Private conglomerates must recoup their billions in investment, and they do so through tolls, routine user fees, and increased service costs. You have to consider if the promised improvements to the nation's infrastructure are worth the inevitable increase in the daily cost of living for the public. As these 252 projects move toward completion, the central question is whether this privatization will deliver the efficiency the country needs, or if it simply shifts the long-term cost of infrastructure directly onto the daily consumer.